Hello, everyone. I'm Rob Meckstroth, Senior Portfolio Manager here at City National Rochdale. I'm here today to give you a very brief economic outlook and investment strategy and preview of our forecast for 2023. If you're interested in a deeper dive with this content, we just recorded our hour-long national webinar yesterday. I'm recording this here on Friday, December 16th. If you're interested in the detailed version, you should have a link to a replay of that presentation in your email. If not, please reach out to your financial advisor and they can provide you with a link to that national webinar. Without further ado, I'm going to dive right into the content. I'm going to start with a focus on 2023 and a recap of 2022. So the big story this year has been inflation. Even though inflation is coming down, we're still seeing inflation kind of in the 7 to 8% range as we end the year. What's notable is our forecast for inflation by the end of next year comes all the way down to 3 or 4% by the end of the year. A pretty incredible change from where we are now. That is good news, but unfortunately, to get inflation down to that level, it has been an unprecedented rise in the Fed funds rate, which you see here. We are closing in on 4.5% on the short-term interest rates at the end of the year, with the Fed likely to increase interest rates more. We think probably above 5% before it's said and done. As we go through this presentation, the increase in interest rates at such a dramatic rate has been the reason that financial markets across the globe have been under stress this year. And unfortunately, we're probably going to be looking at higher interest rates for longer, which will continue to have a negative effect on the global economy. And you can see that up top with the real GDP and corporate profit growth forecasts into next year. Surprisingly, we did not go into a recession in 2022. Unemployment stayed low, consumer spending stayed high, and you can see corporations grew their profits and the economy grew this year. Unfortunately, next year, the possibility looms large that we could see a declining economy and declining corporate profits. In fact, we now have the odds of a recession into 2023 at upwards of 75%. And I'll talk about what that means for the investment strategy for most of your portfolios in a minute. But the economy is likely to fall pretty significantly next year, and we'll work through that. On our speedometers page, as most of you are probably familiar with, this is the first time we have not seen a green indicator, maybe in the 12 years I've been with the company. A few notable indicators here. First, look at the inflation indicator at the bottom left corner. We finally have seen that come back into yellow. That's the good news. We talked about it a bit up front. Inflation pressure is cooling. November and December were the first 2 months this year where inflation shocked to the downside, meaning that expectations for inflation were higher than what actual inflation came in at. Very good news. Unfortunately, the Fed has had to raise interest rates excessively, like we talked about, to get that inflation down. And Chairman Powell just spoke this month saying that we are not out of the woods with inflation, that the Fed will continue to tighten monetary policy. And that bodes well for getting prices down. It does not bode well for the economy. In fact, for the first time this year, the labor market and consumer spending have fallen back into yellow territory, meaning that we anticipate further weakening in the job market, and we anticipate consumers slowing down on their spending. And these two indicators are both central to economic growth. So in some ways, it's good news that we're seeing weakness here in the fight against inflation, but it's bad news as far as trying to keep our economy out of recession. Now, what is our outlook for recession in 2023? I mentioned it up front. We have a mild recession at a 60% chance now, up from 40% last month. Normal recession at 15%, total recession 75%. So our view is that it's going to be unlikely that we don't go into recession, but a 25% chance still that we get slow growth without going into a recession. So if we do get this scenario, and notice how slow growth is still a declining economy, we are going to see the economy decline regardless. But a slow growth scenario is going to be very good for stocks. A mild recession scenario does not have to be bad for stocks. It's the normal recession or worse scenario that would cause much further downside from the levels that we're at now. So the good news is we think the recession that is coming is likely to be mild. And that still means stock market volatility is going to be there, but your downside is going to be a lot lower, or excuse me, your downside is not going to be as low in a mild recession scenario. And I'll talk about what that means for investment strategy. Now, a couple reasons we have strong confidence we're going into a recession. Look at the massive drop in consumer spending. You can see real consumer spending, was so elevated after the pandemic, and now it's come back down to normal levels. And the disposable income per capita on a real level adjusted for inflation is now well below this trend line. To me, this one here on the right is more concerning. When you look at consumers' discretionary savings, the bottom 40% of Americans now have no savings left as far as savings that could go to discretionary purchases. And that all is likely to mean less spending going forward in 2023. So that's great for inflation because as people stop spending, prices will come down, but it's bad for economic health. Now, one of the things interest rate rises do is it really shocks the system in a few different categories. One is housing. Housing has a pretty much immediate effect when interest rates go up, and that effect is negative. Look at the 30-year mortgage. We went from under 3% interest rates up to over 7%, basically overnight. On the right here, the monthly mortgage payment for the average homeowner goes up significantly as interest rates rise. We're talking about a doubling of the mortgage rate. And here in the bottom right corner, look what that does to housing sales. No shock that housing sales are down 31%. So thankfully, this is not a housing bubble that is bursting. This is a correction, a more natural correction in housing. And the good news is housing costs start to come down. Again, we keep taking this back to inflation. When we look at inflation, one of the biggest components of inflation has been inflation in housing up here. You see 7.9% inflation in the November reading, and we talk about a stressed housing market right now. So we expect housing inflation to come way down. It typically is a lagging indicator. And notice here on the left, this is the components of the consumer price index. Housing represents almost 40% of the consumer price index. So it's going to help significantly when housing costs start to show up. And that brings you to our inflation forecast. Note the December 2023 ending number of 2.6%. We really think inflation is going to come all the way down. You can see that accelerating right now in real time from the peak. But unfortunately, this is just one issue that we have. When inflation goes away, we're now looking at how bad is the damage to the economy. So again, we've talked about inflation a ton, but the labor market is still too strong. So we had this in the last video that I did, but even with some layoffs, even with wage growth coming down, there's still fewer than one person available for every job opening. So this is not great as far as really hitting inflation in the short term, but this is one reason why we think mild recession is far more likely than major or normal recession. The job market's just healthy. Outside of tech, you really don't have much layoff activity. You still have hiring. Consumers do not have excessive levels of debt. And all that means is we're unlikely to see the catalyst that is needed to push us into a major recession. You have to have rising unemployment, significant rising unemployment to really push us into a major recession. And unless company profits just start deteriorating overnight, and we don't think they will, it's hard to see unemployment getting up north of 6%. The Fed even believes unemployment may stay under 5%, which would be, very good for the overall health of the economy, maybe not as good for the inflation battle. So the final couple of slides I'll talk about is one of the biggest risks there is an aggressive Fed and more hawkish Fed, that means more aggressive, higher interest rates, more tightening, raises the risk of a policy misstep. And what a policy misstep would be raising interest rates too high. You raise interest rates too high, you run the risk of damaging the economy more than you need to. And right now we're at 4.6%, around that on the federal funds rate. Look at how big the jump has been. This is well above the last tightening cycle. You got to go back to 1980 to find a time when interest rates were hiked this quickly. And this is going to do damage to the economy. But what is often not talked about is on top of interest rate hikes, the Fed is reducing their balance sheet from $9 trillion to an anticipated $6.3 trillion through the end of 2024. So that's going to be another source of tightening. They're pulling liquidity out of the economy. It's going to make it tough for the economy to continue to grow in the face of a tightening Fed. So to summarize everything, we think the U.S. economy is headed into a recession next year, 75% chance of it. But that recession is likely to be mild in nature. And the playbook that we are operating on in a mild recession is very, very high quality companies. Do not go into companies that have low levels of profitability. Do not take on excessive risk. Load up on dividend stocks. Load up on high quality bonds that are likely to continue to pay higher levels of interest with the Fed raising rates, and provide some protection against a more volatile economy going forward. So what you'll find across the board when you look at your own portfolio is it's likely to be a lot more defensive in nature, but it's still invested in high quality US stocks. And I think that's going to be the playbook for the next 3 to 6 months. We'll be watching it closely, but I do think at some point in 2023, an opportunity will present itself to maybe add some more risk. But until then, we expect higher than normal volatility. We expect the Fed to continue to push interest rates up. And as our CIO, Tom Galvin, would say, buckle your seatbelts and prepare for more volatility ahead. Well, thanks so much for listening in today, and look forward to talking with everyone soon. Bye-bye.